with a drastic move by the Monetary Policy Committee meeting of the Central Bank of Nigeria as it raises the monetary policy rate to 13% from the previous 11.5% benchmark. This fresh move tilts to the earlier narrative analysts had projected of a rate hike of at least 25 to 50 basis points. The governor of the CBN, Mr. Godwin Emefiele, describes this as the best and compelling move to tackle the most urgent issue of inflation. According to the CBN governor, other key parameters have been left unchanged, with the asymmetric corridor at plus 100 and minus 700 basis points, cash reserve requirement at 27.5% and liquidity ratio at 30%. The committee was confronted with the choice to hold all policy parameters constant to allow policy measures to support growth or tighten the stance of policy to curb money demand growth and development of domestic prices. According to the committee, a loosening option will likely result in an increased liquidity, rising inflation, and further pressure on the exchange rate. The choice of holding will not only continue to support growth, even though moderately, but will also allow the growth of money demand to continue at the current pace, leading to uptick in inflation pressure. Let's break this down. The two-day deliberation of the MPC, the domestic and global outlook, as well as outcome of the just concluded meeting. I'm being joined by Damilola Akinbami. She's a senior manager, clients and industries at Deloitte. Thank you so much for your time.
Thank you for having me. Good afternoon.
Yes, good afternoon. Now, the latest 13% NPR rate is quite a sharp move away from the conservative stance we have seen from the Monetary Policy Committee. We had consistently seen retention of the rates of 11.5%, but now the biggest word of the day is inflation, and that this has forced some changes, of course, in directions. Do you think this is the best move to rein in inflation, and did this hike benchmark come to you as a surprise?
Well, first of all, the MPC's decision to increase interest rates to 13% didn't come as a surprise. I mean, if you look at what is happening globally and regionally, it's about time the MPC actually did something similar, and it's only a matter of time that it decided to toe the line. So it didn't come as a surprise. And because of the rising price pressures that we are seeing currently in the economy, I mean, it only made sense for the MPC to increase interest rates. And because the primary objective of any monetary authority, of any central bank, is price stability, we expected, and I expected, that the MPC would take this, would make this decision. If you even look at the voting pattern of March's meeting, 40% of the members voted in favor of a hike. So it was about time. And I think for this purpose, it's the right decision. I wasn't expecting a 150 basis hike. I was expecting something more conservative, about 50 to 100 basis points increase. But 150 basis points, I mean, the central bank, the MPC, is definitely sending a signal that it wants to anchor its monetary policy on the MPR, and it wants to target inflation.
Great stuff. Global and domestic issues are of great concerns to the committee members. The pressure, no doubt, is exacerbated by the Russia and Ukraine crisis, from energy crisis to wheat, among other commodities, and the volatility in the currency markets. There were a whole lot on the table of agenda, heightening lingering issues of COVID-19 and more. What is your take on the MPC's scope of discussions for the month of May and the perspective the committee tackled them from?
I think, first of all, with what the MPC has done, it's sending a signal that we're in a tightening policy environment right now. Interest rates are going to begin to increase. So that's the first thing. I expect to see a moderation in inflation, albeit marginally. And why is that? It's because right now, the major factors driving inflation in Nigeria are largely supply-driven and cost-push factors, so not necessarily money supply. But definitely, to an extent, I expect to see inflation pressures being reined into a little bit. Also, I expect to see a shift from the equities market towards fixed income instruments, which will become attractive because of the increase in interest rates. You start to see yields on government securities increase, and that will definitely affect the equities market because of the inverse relationship between equity markets and the interest rates. Aside from that, I expect to see a slight appreciation of the naira. And why am I saying this? Is because one, at least the pressure on the external reserves is expected to reduce to an extent. And by doing this, increasing interest rates, the central bank is going to boost, or there'll be a boost in confidence in the monetary policy stance of the country. And therefore, we expect to see that, that capital flight, which is already occurring as a result of global economies increasing their interest rates, that to an extent will help address that matter. And also the negative real rates of return that we've been seeing will definitely narrow. We're still going to be in negative territory, but at least the real rates of interest on returns would narrow. Because if you look at treasury bill rates for the 1 year bill, it's about 4 to 5%, and you have inflation rate of about 16.82%. But now that the MPR has been increased, you're going to see that gradual increase in other interest rates, other nominal interest rates. So we expect to see treasury bill rates increase, and that would narrow the negative differential. Also, borrowing costs are definitely going to increase. Interest rate sensitive sectors would be affected. So for instance, manufacturing. But I think the major factor that is driving that manufacturing performance is more of the exchange rate dynamics. But aside from that, definitely, interest rate sensitive sectors are going to be affected. We're going to see borrowing costs. Even government borrowing costs is going to increase because the government has been enjoying low interest rates in the past 1 to 2 years. So definitely borrowing costs too would increase.
Brilliant stuff there. Damilola, let's talk about the big one, the electioneering season. And the central bank had to mention this because a lot of spending is expected, either the greenback or the naira, whichever way. We already see what's happening to our naira, according to the figures coming in yesterday at the other market. Now, not the INE window. Some say it's even above 600 naira. Now, what do you think? What effect do you think the high spending ahead of the elections? We have the primaries coming on anytime towards the weekend, the major parties in this contest. What do you think this would have, and how do you think this also shaped the decision of this meeting?
Okay, so during an election season, what you tend to see is fiscal laxity. So there's increased spending on government expenditure as a result. And the CBN, by so doing, also was being proactive. Because like I mentioned earlier, so far this year, the major drivers of inflation have been supply side driven, not demand pull. But definitely, as with the elections draw closer, the elections are next year, February. As we get closer to that period, we're going to see increased government spending, and that would increase the level of money supply in the system. So by so doing this, increasing interest rates now, you are being proactive, and that to an extent would address money supply issues, because once interest rates increase, you are mopping up liquidity in the system, and it has a positive impact on the exchange rate, because once naira liquidity is sucked in, or is mopped up, definitely the pressure on the currency would be reduced. So I expect to see, even if in the short term, a moderate appreciation in the power market rate, and we may even see a unification of rates where the official rate would move towards the power market rate and the power market rate appreciates towards the official rate. So during this period, at least with what the CBN has done, in the short term, I expect to see that have a positive impact on the naira. However, because again, election season, investors usually are wary, and because of the uncertainty, especially for emerging markets like Nigeria, that to an extent might stall inflows of capital, that to an extent might stall inflows of portfolio investment into the country. And we know that one of the sources of forex in Nigeria, in any country, is foreign portfolio investment, which also sometimes tag hot money. Hot money funds, they are very, very sensitive and volatile. As quickly as they come in, they also leave the system if there's any sign or hint of uncertainty. So that definitely uncertainty would definitely still play a major role in the exchange rate dynamics of the country.
Great stuff. We saw the GDP figures for the first quarter of 2022 yesterday from the NBS. Nigeria grew by 3.11%. I was thinking that this is part of what, of course, they cited that also at that meeting. But let's look at the fundamentals fueling this growth. How inclusive really is it?
Well, like the CBN rightly said also during its meeting, it said any inflation rate, or the inflation rate that is above 12%, is growth retarding. So that just shows you, our inflation rate is 16.82%, and we're growing at 3.11%. So that just shows you that that is growth retarding. And the growth that we recorded in Q1, if you look at the major drivers of growth are largely in the services sector, the non-oil sector. So the likes of finance and insurance, the likes of information and communication technology. These sectors are not major employers of labor. So that just means that this growth is not inclusive. If you take finance and insurance, if you take human health, if you take ICT, if you combine these three sectors together, the total share of employment is less than 5%. However, the major employers of labor, so for instance, agri grew about 3%. Agri's contribution to GDP is also significant, it's about 26%. So it just shows you that there's a disconnect between the drivers of growth and the job creating sectors. And that just shows it also that there are some resources that are untapped. The potential growth rate of the country is about 0.4%. So this is the first time that Nigeria will actually be growing above its potential GDP. But this is just first quarter growth. And I believe that, let's see how the remaining quarters pan out, because if we continue on this trend, with the low investment, with the difficult business environment, that definitely will affect the performance of the economy. So reforms that would unlock opportunities, reforms targeted at boosting productivity definitely will lead to an increase in output. And that to an extent should, especially if we're investing in real sectors that are job creating, we expect to see an inclusive growth later on in the year.
Great. Well, let me follow up with this. The central bank identified many of the support, or let me say developmental projects being embarked on by the Apex Bank, supports to the real sector that we know in trillions of naira. I know you've been following this. Let's just move a little bit to that space. Pharmaceutical space, the creative sector, we can go on and on, the fintech space and all of that. What would you say about the impact of all of these interventions with regards to economic growth and development?
So, good initiative by the CBN, with all the intervention schemes, aside from even the chemicals and the creative sectors. I know that the CBN has invested heavily in the Anchors Borrowers Program, which is tied to the agricultural sector. So yes, these are good initiatives and laudable, but there is room for more. There's room for more investment. The creative sectors and the pharmaceuticals, like I mentioned earlier, these sectors are not growth inclusive, they're not job creating. So you need to invest in the sectors that have a more significant impact, whose contribution to GDP is significant and have a spillover effect. So at least we are seeing that in agriculture. So aside from even this investment, what else is being done to address the issues, the challenges facing these sectors? So one of it also is the business environment. How easy is it to do business in the Nigerian economy? What is the perception investors have about doing business in Nigeria? Because these are some of the issues that need to be addressed. Because if there's investor apathy in an economy, that would definitely affect the level of investment flows into the country. So the low or how low your level of investment is would determine to how low the multiplier effect would be. So you need to increase the investment multiplier so that the spillover effect to other sectors, especially the job creating sectors, will be huge and the magnitude will be felt in overall GDP.
You touched on borrowing costs, and I'm particular now about government's borrowing costs, particularly at a time where we know that the government might just need to borrow. A lot of issues to sort out, and we know that infrastructure and all of that. But tell us directly, what are your thoughts with regards to a country in debt and high borrowing costs at this time?
Well, right now, we expect to see government's borrowing costs increase, both domestically and externally. External debt definitely because of what is happening globally. We know that the US, the US Fed, the Bank of England, and other major developed economies are increasing interest rates. So definitely external debt for the country is going to increase. Now add that to domestic debt cost, which would also increase as a result of the recent hike in the monetary policy rate to 13%. So for Nigeria, it raises concerns of the debt sustainability of the country, which a lot of multinational agencies have been talking about. The IMF, the World Bank, even economists in Nigeria have raised that concern about the debt sustainability of the government. And this is also as a result of the fact that the major source of revenue for the government, the oil and gas sector is under, we know what is happening. If you even look at the Q1 numbers, the oil and gas sector contracted further to minus 26%. And this is despite the fact that oil prices are even trading above $100 per barrel. So it just shows you that disconnect. And again, because our production levels are low, so we're not benefiting from high oil prices. So as long as the government, or the economy rather, remains highly dependent on oil and gas for its revenue, we are going to see that's constraint on revenue. So the government needs to invest more or focus more on creating more revenue opportunities. And we're already seeing that being done. We know that there are increases in tax, various tax rates, and the government focusing more on the non-oil sector just to boost its revenue drive. So right now, the debt to GDP is a major concern. More importantly, is the debt to revenue ratio, which is an indication of how much the government is paying to service its debt. Almost 90% of what is earned is used to service the debt. So then what is left to invest in the real economy? That's a major question.
Great stuff. Then before I let you go, we've seen the direction of the equities market for some time. And of course, analysts say that the decision here might or might not affect the market moving forwards. I like your thoughts around this. And when are we likely to start seeing that kind of investment? Will we start attracting that kind of investment into the Nigerian market again? When will we see that investment coming back?
Okay, so like I mentioned earlier, there's an indirect relationship between interest rates and the equities market. So now that interest rates have been increased, we're going to see that shift away from the equities market towards fixed income instruments, because yields are going to increase. And why the equities market has been performing so well so far this year, and even last year, it was one of the Nigerian stock exchange was one of the best performing stock exchange in Africa last year, and I think 2 years ago. And why we've been seeing that is because of the low interest rate environment. But that has changed now. So the equities market definitely will experience a hit to an extent, or some hit to an extent. However, because of the low investment opportunities, I think that the equities market is going to bounce back, albeit obviously maybe not increase or grow as fast as anticipated or as we experienced earlier in the year. But I think, we're going to begin to see that play out. And also because of what is happening globally and because of the uncertainty, and as we draw closer to the elections, again, investor uncertainty about what is going on in the economy, investor sentiment will continue to drive their participation in the Nigerian stock market. And we are beginning to see that move, shift away of international investors from the Nigerian stock market, and that is going to continue to play on the performance of the equities market. So I think to a large extent, definitely the equities market will be impacted by this interest rate decision. But there's still some companies, there's still some sectors on the stock exchange that would still be a good buy. So for instance, the banking sector, because banks stand to benefit from this increase in interest rates, because they're also major players in the fixed income securities. So definitely the banking sector on the Nigerian Stock Exchange will still be a major sector to look at for investment opportunities.
I must thank you so much for your time, Damilola Akinbami. There, she's a senior manager, clients and industry at Deloitte. Do enjoy the rest of your day, and thank you for making sense of all of these figures for us on Business Nigeria today.
Thank you for having me.